So Index Universal Life offers a lot of different options as far as cap rates, participation rates, no cap products. All this stuff is just smoke and mirrors, and I want to show you why with a breakdown utilizing one illustration as an example. Check this out. So you can see here that there's multiple options here for indexes. You have an option with a cap rate, you have an uncapped option right here with a spread charge, and you have uncapped options all the way down here, and they have different types of participation rates and different charges that come into play. Now over here on the far right side, you can see that the maximum permitted illustration rate is about the same on all of them. And there's a reason for that. It's because at the end of the day, no matter what is going on inside of the policy, whether it's a cap rate with the 9% or whether it's a participation rate ranging from 115% to 220%, they have the ability to reduce the cap rate to 4%, reduce the participation rate to 65%. If it's a spread charge, they have the ability to raise the spread charge, meaning the amount of money or amount of gain that the index has to earn before you actually have crediting inside of your IUL. They can raise it from 7.5% to 10% in this example right here, right? So no matter what it is, there are these moving parts, and it doesn't matter what index or what lever they're using, they are gonna have a lever they can use, and here's why. It's because they're dealing with options. IUL products are options-based products no matter what. So let's say you have $10,000 that goes into a policy. That $10,000 has an options budget that is created by the performance of the general account. Let's call it 4%. That's going to create a $400 options budget. That $400 options budget goes and purchases call options. That call option is going to produce a result, whatever. If it wins, then you're going to have a gain, and that is how they develop the cap rate. That's how they develop the participation rate, or whatever it is. That's how they do it. And if it loses and the index loses, you lose the $400 that was gained in the general fund with a 4%, and your $10,000 of principal is protected. That's how this works. At the end of the day, it doesn't matter what cap, what index type is being used. They're dealing with the same options budget based on the performance of the same general account. And so you can't draw blood from a rock. All the other noise is just smoke and mirrors inside of IULs. If you don't understand options and how they leverage options to do this, you shouldn't sell it, you shouldn't buy it, and it really is that simple. Comment if you have any questions. Make sure you follow the channel if you want to learn more.